I'm delighted to let you know that the 2024 year and the festive season for 2024 closed in a very positive position. And this was largely driven by growth in trading densities, growth in rentals, as well as a very stable rent to sales ratio over the course of the year.
We had clearly interest rates that started coming down off the back of inflation also coming down, and all those conditions are very positive.
In terms of politics, was a little bit more stable than previous years.
Load shedding not being there as well really helped.
I think the two-part retirement system also aided with consumer pressures.
Shopping centres are a destination for where our consumers want to be, and it's quite clear that retail therapy is back in form.
The purpose of Clur Connect is to portray the strength, the diversity and the resilience of the South African retail sector. And I feel that this is not only relevant from a local perspective, but also from a global perspective. South Africa actually has one of the largest retail footprints in the world. And further than that, South Africans are typically very bad at selling themselves on the global stage. And when it comes to the world of retail, we actually have so much to teach the world. And this is evidenced through the fantastic design of our shopping centres, the incredible way in which asset management takes place, as well as the entertainment facilities and the pioneering and brave attitude and creative aspects of the retailers that fill the shopping centres in South Africa. Clur Connect is part of the Clur Collective, which is a holistic asset management support platform for shopping centres and the retail industry, which currently covers just over 5.4 million square metres of space and just over 130 shopping centres across the South African retail sector. For the full 2024 year, the National Clur Index closed with a trading density of 40,724 rands per square metre and year-on-year growth of 3.5%. This growth actually outperformed December 24 CPI by half a percentage point, but underperformed 2024's full year CPI by negative 0.9%. This actually reflects the uptick that we saw in economic fundamentals in the latter part of the year. I'd say that the highlights of the festive season were that firstly, the combined festive season, if we look at November and December together, outperformed in terms of both trading density and growth rates relative to the rest of the year, in other words, the January to October period. For these 2 months, the National Clur Index annualized trading density was 55,844 rands per square metre, and the growth was 6.2%. Within this context, we saw that super regionals, which are the centres that are over 100,000 square metres in size, saw the highest combined festive season trading density of 71,128 rands per square metre, while small regional centres had the highest growth rate of 9.2%. The rest of the year, in other words January to October, traded at a much lower 37,705 rands per square metre with 2.8% year-on-year growth. What we also saw, if we break November and December down separately from each other, is that November showed the higher growth rate in terms of trading density, but December actually showed the higher trading density level in terms of actual value. And this is actually a very interesting interplay if we compare to what happened last year, because last year we saw that December's trading actually left Black Friday in the shade in terms of both trading density level and trading density growth rates. The December 24 National Clur Index closed with an annualized trading density of 65,030 rands per square metre and year-on-year growth of 4.5%, with super regionals again hitting the highest trading densities of 84,230 rands per square metre. And we saw that small regionals had the highest year-on-year growth rate of 9.4%.
So 2024 December was a very good month off the back of what I call the tailwinds of the economy, no load shedding, etc. So December definitely traded better than November for us, so we saw a significant improvement. in our retail sales.
We did see a momentum that started on Black Friday and continued through to Christmas. I think probably a lot of people also, instead of just hiking prices, sort of kept prices pretty reasonable, so it was still attractive for the shopper. So definitely the best season we've seen from Black Friday into Christmas, and there wasn't a big drop-off between Black Friday and Christmas.
We saw a bumper and vibrant trading environment over both November and December. And November outperformed significantly because of the 5 weekends that was there in November compared to 2023.
Black Friday for the last couple of years has evolved from being a single day to being a period. And we've seen that the shopper patterns have stretched out over a week rather than a particular day.
Our experiences at Attack on Black Friday 2024 was definitely stronger than 2023 Black Friday, and even the spend as well was a lot more impactful, I think, particularly because the Black Friday was on a weekend, whereas 2023 it was midweek. And so those sort of nuances in timing on Black Friday really impact on the spend that we see in the assets.
Interestingly, from a provincial perspective, we saw that the Western Cape had the strongest November in terms of both trading density and year-on-year growth rates. And when we looked at December, we saw that KwaZulu-Natal was the shining light and came through with the strongest trading densities and the highest growth rates on a relative basis. And what this illustrates is the importance of the summer holiday season for the province of KwaZulu-Natal in terms of driving economic performance. The November 24 National Clur Index closed with an annualized trading density of 46,755 rands per square metre and year-on-year growth of 9.1%. Again, super regionals hit the highest trading densities of 58,236 rands per square metre, and the highest growth rates were achieved by community and smaller centres at 10.2%. We also saw that the Western Cape had the highest trading density across the 3 provinces of 53,439 rands per square metre, and it also saw the highest year-on-year growth of 10.2% for November 24. It's clear that during this festive season, we saw differing strengths offered by both November and December, which culminated into a solid festive season performance. The first standout influence was definitely that there was a clear shift in the positioning of large and small centres, and we actually saw that smaller centres took over the dominant growth position in the industry. This finding is reinforcing signals around social impact retail and community involvement across South Africa.
As a social impact investor, yes, we worry a lot around social. And the social is about how we can restore dignity to these communities that we serve by bringing the economy to those communities. So we're saying by building these environments in those communities, hopefully we're getting parents to be more present at home, which means the social ills of gender-based violence, alcoholism will hopefully be addressed. And clearly on the environmental side, we continue to look after energy security, which talks to solar. We continue to address issues of water by providing backup in our environments. And we continue to be responsible in terms of how we manage waste within our environments.
I feel that social impact retail actually ties in with a broader global theme, and that is the current consumer need for balance and wellness. And what we've actually seen is very interesting, because when COVID hit and just after COVID, we saw that there was a big emphasis on personal wellness. That then seemed to grow and evolve into much more of a community and global wellness theme. And that in recent years has actually further evolved, from what I can see, into a financial wellness theme, as well as a focus on mental wellness. It almost feels to me like a pushback on the stress and the shock that we've had over the last number of volatile years since COVID. And so there's an emphasis on having a life affair and very much more of a La Dolce Vita attitude to life.
what we found is that customers are looking for unique experience and immersive experiences in our shopping centres. For December trade in particular, we found that there were notable categories that outperformed. Entertainment, healthcare, beauty and athleisure outperformed.
I think particularly we saw a strong recovery in entertainment, particularly influenced by the cinemas, parents bringing their kids to the cinemas during the holiday period. At the same time, spending in our restaurants and our dining environments, there has been strong trade.
We definitely saw a lot more discretionary spending across apparel, shoes, fine jewelry, all consistently outperforming the essentials categories like pharmaceuticals and groceries.
There was good growth in our grocery offering. Our pharmacy offering also performed well. Our best performing categories were bottle stores and drive-thrus. We did see an uptick in apparel, especially the outlet athleisure stores.
So in terms of our experience, the standout category in our portfolio was mainly food retail as well as fashion retailing compared to other categories of retail.
One of the most encouraging things that we've seen is that there's been a continued position of reduced market risk. And this is indicated by the rent to sales ratio maintaining at the lowest level of 6.6% over the full year. And this is actually the lowest level that the rent to sales ratio has been in the market since COVID hit.
Going forward into the 2025, we definitely think that the trends will still grow, but marginally, unless big economic factors really stimulate growth. From a rental performance, we do expect it to grow. Our strategy is always to incentivize the tenants to keep refurbishing their stores, giving us the best brand new looks and feels of their stores. Often we find it's anything between 20% and 30% of a tenant after revamping. The growth in sales is around those figures that I just quoted.
Our expectation for 2025 is continued stable growth, maybe at a more stable growth rate. I don't think it will be as accelerated as one would hope as a landlord. I think from a consumer perspective, people will have money. We've got the right brands and retailers in our mix that'll entice them to come and shop in our environments.
So we're still seeing a lot of investment going into convenience retail aspects of the market. I mean, we are a small player and we are likely to invest an additional R1 billion into building new products or buying existing products, so that's quite exciting.
So our expectation, on trading and rental is at least that our growth keeps up with inflation. I don't think we're going to see the boom yet we saw back in, I think, that period of 2004 to 2008, where you seeing the 8, 10 and 12% increases.
With retail therapy returning, we've seen the appetite for consumers to spend. Dwell time has improved, trading density is up, foot count is up. Retailers have now aggressively demanded space, and we find that retailers are continuing their strategic store rollout aggressively. What we've found is that renewal rates have improved significantly in the year, and we expect this momentum to continue throughout 2025.
As our index has grown in coverage, we've been able to drill down to a much more granular level in terms of provincial performance. And here we've seen that the Western Cape has been on a performance trajectory that seems set to continue. We also see the heartbeat of Gauteng coming through with absolute solid consistency. And we've also seen that KwaZulu-Natal has come out of a very volatile period and has actually come through with a real uptick in performance towards the end of 2024. I'm delighted to say that this culminates into a very positive picture that bodes extremely well for the rest of the year.